My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Jeffrey Hirsch, the man behind the Stock Traders Almanac. Jeff, I know we know each other, but for those who are not familiar with you, just introduce yourself real quick here to the audience. Who are you? How'd you get involved in markets? And what are you doing with the Traders Almanac?
Thank you, Michael. Great to be with you. Thanks, everyone, for coming. My name is Jeffrey Hirsch. I am the son of Yale Hirsch, the man who created the Stock Traders Almanac back in the 60s. 66, he incorporated. 68 edition came out in 67. He's the guy that invented the Santa Claus rally and the January barometer, which we'll get into. I took over from Pop around 2000, 2001, and we lost the big guy at 98 years old in November 2001. Heck of a run. We have a service at stocktradersalmanac.com with members-only subscription content. And I'm also at Almanac Trader, as you guys probably can tell from here. So reach out and ask us for anything you want. We're always available.
All right, let's first go into what happened last year from historical context. I recall last time we did a space, Jeff, that to you it was somewhat foreseeable in the sense that history would suggest that year was destined to be probably a poor one anyway for equities. But how did last year compare against other things in the data set that you look at?
Well, I mean, we're 4-year cycle people. The Almanac is, on a 4-year cycle itself. This year's edition is the pre-election year edition. Last year was the midterm year edition. So, I mean, without pulling punches, 22 was textbook midterm year action. Bear markets, recessions, and wars tended to begin in the first 2 years of president's terms. Midterm years, definitely. Yale dubbed it the bottom picker's paradise. We've talked about October. Yale was talking about October back in the 70s being this, October phobia month at the, beginning of the fourth quarter, after the end of the third quarter, that's negative. So almost a quintessential midterm election year bear market with an October bottom. I mean, I would say you can't write this stuff, but I do write this stuff. So, it really set up well for the cycles and the seasonals. We also look at technicals, fundamentals, monetary policy, sentiment, all that stuff. And, that also fell into the, the bear market area as we started getting more cautious, more negative around this time last year, and especially after the invasion on the 24th. And then as we started breaking through stops and, we didn't get the positive beginning of the year. We broke the December low, which we can talk about all that stuff. But it really just played out as the cycle calls for it. And there was a lot of confirmation across many disciplines. And it did set up our outlook, a bullish outlook for this year, which is we're getting more, convinced of as the data comes in. So that's kind of where we're at.
How did that? So I'm with you. Textbook on last year. I would argue that the path was very unusual in the consecutive types of weekly declines and the way the VIX behaved, not having a spike. But clearly, the second year is midterm years tend to be pretty weak. How does that compare, though, when you do that analysis to what happened in the bond market? Aside from the fact that you've never seen treasuries have that kind of a sell-off, what's the typical seasonality for bonds in that 4-year cycle?
I mean, bonds used to go inverse to stocks. I mean, in the best and worst months, we'd be in bonds and out of stocks. We saw all asset classes, including, precious metals and stuff, though gold's coming around a bit now, all going in one direction. I think that is due to the, what was the ZIRP policy, the zero interest rate policy, and the massive amount of quantitative easing that we have. I'm not sure it's ever really going to go away, but I think that changed the bond cycle to really run with the stock cycle. I suspect because of what happened last year, with it being a real typical, 4-year cycle midterm year, and with the Fed getting off the schneid, that we may get a return to, sort of an inverse or correlation with stocks and bonds. We've seen some of these things before. I mean, at the end of the 90s, all those years were up where there was no 4-year cycle for a couple of cycles when it was just straight up with the dot-com boom. And then it did return. I don't know if you remember the midterm 02 bottom. Yes, we did have a retest in March 03, which some people have referred to. But I think bonds got sort of turned on their head because of Fed and fiscal policy. And I think that's maybe returning to, more normal or older school cycles that now that we're back to sort of normal there.
Yeah, and actually that's going to be a big theme, obviously, throughout this hour here. But for the audience, maybe just explain what's the causation behind the presidential cycle, the midterm year being typically the weakest of the 4 years. I saw some people commenting on this point, saying, "Oh, that means I should just do it based on history." No, but there's a reason for it.
Not just based on history. I mean, that's what we do at stocktradersalmanac.com. We take the history and overlay it with what's going on the ground, with technicals, internals, advanced declines, breadth, new highs, new lows, sentiment indications, as well as fundamental analysis. So it's not just go with history. History rhymes, it doesn't repeat exactly. There are, forces that override history. Is a famous quote about, I think it's from Edson Gould, the old findings and forecasts editor, an old newsletter from the 80s, where, if the market doesn't go up during the bullish seasonal period, that means there are other forces at play. So watch out when that bullish season's over. So, when seasonality is not working, it's an indicator. But what creates the 4-year cycle, we're kind of seeing it right here. It's the drive and effort of the incumbent party, the incumbent administration, to retain power. So what happens when they come into office in the first 2 years, they take care of what I call the sort of more unsavory policy initiatives and set themselves up to really prime the pump in the pre-election year. And we cite some of that stuff in the book, in the Almanac, if anyone has that and wants to look in there. But case in point, this cycle, the Fed, which is, kind of working with the administration because they get reappointed and that sort of thing, took care of the dirty work last year, still doing a little bit right now, but right now it's winding down the pre-election year. I don't know if anyone was watching the sort of tour that President Biden's been making about infrastructure. He was just in New York talking about repairing the Amtrak and local commuter train tunnel to Penn Station. And they stopped in Baltimore. So he's already out there making his rounds, talking about primarily spending money and talking up all the things that the Democrats and the administration are doing for the country and the voters and the people. So this is the initiative. This is what creates the 4-year cycle, is the fact that unlike any other nation in the world, we have a regular election for the leader of our country every 4 years. I mean, how many times have Israel and the UK changed their government in the last year? I can't keep count with this parliamentary votes of no confidence stuff. That doesn't happen here. It takes a lot more effort to get rid of a president. They tried to do that with Trump a couple of times and it didn't work. You gotta get a lot of people agreeing on things to get a president out. I don't think it's ever really transpired except for Nixon resigning in my lifetime. But it's that regular, we call it the quadrennial quadrille, the 4-year cycle dance with the market and, Washington, D.C. And that's one of the things that drives our outlooks and our analysis.
You had mentioned Edson Gould, which was referenced in the 2014 Dow Award on utilities, because Gould, as a sort of legendary technician, would often look at utilities as a leading indicator. Let's talk about sectors for a moment. In that presidential cycle, what sectors tend to do better based on whether it's first year, second year, or the third year, the pre-election year, which we're in now?
I don't think the sectors run as much in the 4-year cycle. I think it's more of a business cycle driven pattern with the cycles and some more rotations with how they're doing. I haven't really seen a distinct 4-year cycle pattern for individual stock sectors. I think it depends upon the policies of the administration of which sectors, are going to be, more favorable with what's going on. So I don't really see a whole 4-year cycle sector pattern that we've ever seen. So, it's more broad market with kind of the rising tide lifting all ships in pre-election years. I think with the tech-driven economy and world that we have now, and we had a big tech recession sell-off last year, sort of seemed to, bottom out at the end of the year with all the tech layoffs on the horizon. Looks like that's going to happen. I mean, there's a couple other things that are pointing to me for NASDAQ, but if you want to call tech, in general a sector like the NASDAQ or the QQQ, when I look at that sweet spot of the 4-year cycle, which I have on a some of the charts. I think it might have been one that I put out last year where we had the 4-year cycle for the Dow, S&P, and NASDAQ. And you see during that sweet spot, which is we're in the middle of right now, Q4 of the midterm year through Q2 of the pre-election year, Dow and S&P are up about 20% over the 3-quarter period there, and NASDAQ up 29.3, almost 30%. So if you wanted to look at something, and tech's been, leading right now, as have small caps, but that's a little early year January effect as well. Tech's probably a good place to be. I do own the Qs myself, full disclosure. Picked some more up last fall on our buy signal. So I would say technology is probably sitting in the sweetest sweet spot right now from what we've seen.
And I just shared in the nest exactly that tweet, and because I've used it myself in referencing, why also early October I was saying, the end of the world is the bull case, and that's why melt-up's about to take place, with the exception of that December, kind of high risk period. So it is interesting to me, though. It's I feel, especially on FinTwit, that people just keep gravitating towards certain old narratives when they're not looking at historical probabilities and cycles, because they're thinking that this time is different. Do you find, as you communicate to clients, to people that when you talk about these cycles, that in a year like this year, there's more skepticism? Well, this is going to be the one time where the probabilities don't favor it. How do you kind of communicate when there's this entrenchment of a narrative that isn't based on anything except headlines?
I mean, I like it when people get angry at what our analysis and our calls. It tells me that, when we hear a lot of people going against and being, shocked or startled with what we're putting out there, it kind of lends me to believe that we're onto something. Anecdotally, back in 2002, when we put out a big buy, buy, buy headline, which was reminiscent of Yale's 1974 buy, buy, buy headline, we received a lot of subscriber, not hate mail, but just, what are you, crazy? You can't put out this bullish forecast. So everyone's pretty keen these days on just reacting to headlines and, short-term reactions, which, if you're a nimble day trader, have at it. I know I have colleagues and friends that do well with that stuff. They have great trading techniques. A lot of them are technicians, but when it comes down to it, people say, LOL, seasonality is not working anymore, or how could, that's not going to work when the Fed's hiking and inflation is very high. Well, historically, we've seen the market is an anticipating mechanism. It's a barometer, not a thermometer, as my father always taught me. And the market is looking out across whatever economic, valley of despair that we see here into 6, 8, 12 months out into 2024, with, past this sort of earnings trough that is, S&P Capital IQ forecast earnings to bottom here in Q2 of 23. So, my comment to people is, well, the more of you that disagree with me, the more my contrarian tend to purr, and the more comfortable I am with my outlook. Granted, there's going to be bumps along the way. Our forecast for 23 was, choppy start, and then the pre-election year bull emerges. I think my biggest fear right now is that I'm not bullish enough. The market's going to surprise to the upside, which seems to be the least forecasted outlook there. Maybe Tom Lee's the most bullish.
Yeah, and I've been pretty. I always use that line. It's like, you're right when the counter argument is an insult. Right?
Yeah,
and I've seen that so many times, especially around this kind of, when I pivoted back to conditions are there again for the melt up. After the first week of January. By the way, those in the audience, please do me a favor. Invite some of your colleagues and friends that are on Twitter to this space. On the very top, there's like a up arrow. Click that. Click invite by DM. Any kind of help in spreading the word while this is live is always really much appreciated if you enjoy these kind of conversations. I'm curious, Jeff, is there any change in the behavior of the 4-year cycle in the pre-GFC QE era versus the post-GFC QE era? And I say that because QE did, at least for the S&P, in particular QE3, cut off a lot of the kind of left fat tailness of large caps, right, and became a very smooth bull market. Any structural change that happened to the way these years play out? Pre-GFC, post-GFC?
I don't know if it's structural change, but paused, temporarily off. As I mentioned, the late 90s raging bull definitely impacted the 4-year cycle and basically There was no down years. There was no weakness in the first 2 years, and I think temporarily, as I quoted Edson Gould before, and of course you're one of the people that will remember who he is. There are times when there are forces that are stronger than cycles and market behavior and seasonality. And there's things like war and pandemics and zero interest rate policy, and the ATMs of when homes became ATMs, and we had the housing crisis and the financial crisis. Sure, that's going to override the 4-year cycle and seasonalities and other trends and patterns. And that's why we look at other data and other disciplines to keep us in check and make sure we're not just blindly following the historical patterns when there's something that's impacting it going on currently live in the ground.
Let's talk about the average returns in pre-election years. It's the strongest of the 4-year cycle, so the Bears have a hell of a headwind to fight against just based on history for the year,
Yeah.
right? What's sort of the range? What's the average that you've come across?
I mean, it's like 16%, 16.4 for the Dow. It's even stronger for the S&P and NASDAQ. I mean, our forecast is for average 15 to 20% returns for a best case scenario here. It's something that, I mean, low end, you've got years where the market's getting taken out, but most of those years are not pre-election years, and that's why the pre-election year is so strong. It's interesting if you look at the combinations that we put this chart out in the Almanac, and it's also in our subscriber reports. Combination of all pre-election years for the S&P up like 17% on average. First term pre-election years up closer to 20. And you got pre-election years after a midterm year bear, a little over 20. And then we took our aggregate cycle, which combines the decennial pattern, which I don't put a whole lot of stock in, but it's something we want to keep an eye on, the third year of the decade, as well as the pre-election year, and then all years going back to 1949, and that's still just over 12% average return. So, I mean, you're looking at double digits for the most part for the pre-election year. There's, few and far between that have not been up, and it's usually caused by some overarching exogenous factor. I mean, what did we have? The 2011
Summer crash,
we had
right?
the debt thing, and then there's been a couple of years, but it's always something that's overriding it. There's something bigger at play, and it's really, we had 2018 was another midterm year that was down there. What was it? 2015 was down 2%. I mean, there's been a couple of small losses, but usually always impacted by something that's not systemic. It's exogenous events.
As I recall, 1987 was a pre-election year.
Yes.
Right? Then the Dow still closed positive, right? But so the Dow rise, I think something like 30% up until Black Monday, right?
Yes.
But so for the full year, it would still kind of fit in the positive cycle dynamic. But talk about volatility on average during these kinds of years. So you can have an up year, but you can have a volatile up year.
The thing that's most important is these negative or at least volatile pre-election years that we're talking about. And thank you for remembering 87. Slipped my mind there. We're not preceded by bear markets in the previous 2 years. So the conviction for this year comes not just from the historical pattern for the pre-election years themselves, but for the 4-year cycle and the fact that we've had this bear market. I mean, there are people out there that are going to contend that we're still in the bear market and we're going to, make a new low. I don't see that. I'm seeing some technical confirmation here, which we can talk about in a minute, but it's really supported and important about what happened in the prior year or two. So if you don't have a bear market in the first 2 years, that makes the pre-election year prone to more volatility. But that is not the case this cycle.
Yeah, I mean, it's interesting to think through sort of the way that this plays out. So last year, on a real return basis, the 7th worst in history for the S&P after inflation. I myself am of the mindset that I personally think there's a credit event looming out there that might break the lows, but not yet. That you have to kind of maybe suck in more bulls before that, which would almost be like an 87 style type of year, right? Big up and then sudden event. But since you mentioned the technicals lining up, let's talk about the short term. one of the things I see a lot on Twitter in relationship to the Fed and why you should be cautious, and maybe why Michael Burry just yesterday said sell, although nobody knows what he actually said sell about, is this idea that, well, commodities are surging. So inflation is going to come roaring back. I personally don't view it that way. I think this is just an oversold bounce, and it may be more growth than inflation. But what are some of the things that, from a short-term perspective, you are observing that make the bullish case?
I mean, you get into the technicals. I mean, we've got several different breadth thrusts and momentum thrusts from guys like Walter Deemer and Wayne Whaley and other people out there that are showing underlying broad market strength. You've got, I mean, you look at the pulse of the market that we put out where it shows new highs and new lows. The new lows bottomed in June. We're seeing more encouraging numbers in the market internals. And then there's this downtrend line that everyone drew from the January highs up until recently that was
the perfect downtrend line, by the way. Everyone, they love that line.
But we've been poking through that, and we've made some serious progress and constructive upside behavior on that. I think NASDAQ last time I looked, and the NDX, which we look at also, has struggled to break through that. And there's the 200-day. I mean, we had a golden cross in a Dow with the 50-day coming up through the 200-day. Russell 2000 held its closing low from June and showed strength during that small cap week period in October. NASDAQ did make a lower closing low in December, but if my eyes are correct, Dow, S&P, Russell 2000, NASDAQ all made intraday lows on October 13th. So I'm seeing encouraging breadth numbers, new highs and new lows. We're getting some positive action out of the moving averages. We're breaking that trend line. I could show you an inverse head and shoulders on the S&P with the June lows, the October lows, and the December lows. Somebody who's drawn that trend line, the perfect trend line you were talking about, was showing other resistance coming off the down slanting neckline from the head and shoulders top, November, January and March, or there's like two different necks there. But as I said, inverse head and shoulders in play, and then there's sentiment. There's a lot of bears still on the sideline. Yeah, bullish sentiment is up, but it's not that there's no, it's not to that level where it's so concerning. And there's a lot of different sentiment indicators out there. I tend to gravitate towards investors' intelligence, percentage of advisors bullish and bearish. You've got people who are paid for their advice. We're on that list, as opposed to the surveys of people telling you what they think the market's going to do. Always like put call ratio, especially the weekly one that used to be in Barron's. But with the options market being flooded with all sorts of different expirations, I think that the equity only put call is a little bit, it's changed. It needs to be reevaluated. But we did have a spike. I guess it was December near the low there. We have it in our outlook.
Although, real quick, I will say, just it's interesting. So I'm with you. I mean, you can argue the put call ratio is not as,
when we bottomed, put calls we had that spike, but that includes all those zero, data to expiration ones. But go ahead.
No. What I was going to say, I mean, so I'm with you that the put call ratio probably is not as much
and
of a
VIX too.
And VIX too, right? But I'll think actually there's another angle to that, which is that to the extent that you have manic volume in zero DTE type trading, that can be, I'd argue, independent of whether it's a call or put, that can be a contrarian indicator only because, as you know, right, most returns come from close to close, not open to close, right? In other words, if everybody is increasingly making very short-term day trading type of options bets, to me that seems like almost a bearish signal, which if the volume is very high, may actually be bullish because nobody wants to hold overnight.
Yeah, it's a fear indicator. And it may not be ruined, the put call ratio. It may be just the levels may be changed on it. We may have to reset the benchmarks.
I do also think that the sentiment point is interesting to focus on, because I see this all the time on Twitter. People say, "Oh, you're at extreme greed. That means we have to fall apart tomorrow." It's like, no, bulls stay bullish for a while. Overbought stays overbought for a while. Personally, I've always thought that sentiment isn't predictive in the sort of idea of extreme greed. It's more about the extreme fear where it's predictive.
It's much more predictive on extreme fear. And this is sort of the reason. I mean, about our best and worst 6 month switching strategy. Some people like to say sell in May, but that's not what you got to buy in October to get yourself sober is my retort to that. But We use MACD, the really reliable indicator that I'm sure most people know about, to trigger our buy and sell signals either after October 1st, on or after October 1st for the buy, and on or after April 1 for the sell. The last month of the best months, or June for NASDAQ and Russell. But getting to the bottoms being more, fear being more indicative at bottoms. I mean, we use the shorter MACD, the 817.9, which is what Jerry Appel, who invented it, originally told everyone, originally decided that was better for bottoms because it's shorter. Bottoms are an event. And, that's why you use a shorter and faster MACD to identify that turn, whereas tops are a process. They take more time to develop. And that's why we use that 12-26-9 for the sell signal. So to your point on sentiment indicators at their extremes being, more constructive or more useful at calling low at bottoms and turns, it's definitely the case. And bullish sentiment can go higher for longer. And we saw that happen with the bear sentiment a bit in 22. There was a few different periods where we had the bearish numbers up pretty high in June. And, that's where you got to overlay with a few other things. But we are not there at fully scary, contrary bullish sentiment right now. There's still plenty of bears and people expecting a correction on the sidelines to keep fueling this bull. I mean, it's kind of that wall of worry that, everyone always talks about that we've been climbing and probably will continue to climb for a little while.
Let me reset the room for the remaining minutes here. Everyone, please make sure you follow Jeffrey Hirsch. And I highly personally recommend, I'm not getting paid to say this, Stock Traders Almanac. I mean, I've always been a fan of the type of work that Jeff and his family legacy has put out there. I highly, highly encourage people look at this instead of falling for the tweets from anonymous bear accounts that get the most likes with information that everybody else knows that has no predictive power. At least if you can identify where you are in the cycle, you have a better chance over multiple roll of the die. That's where the Stock Traders Almanac really is helpful. Again, this will be a podcast on all your favorite platforms. And please, everybody here, DM your friends, your colleagues, get people to join the conversation, and don't hesitate to come up and ask questions.
I mean, I'm not a huge Elliott wave guy. I assume that's what you're talking about. Fibonacci numbers are interesting. Whether it's the next couple of weeks or the next few months, I think there's some key resistance levels that we're talking about. I mean, I think that's what the crux of your question and point is. We talked about the trend line that we've gone through. We still need to leave it more in the dust. You've got those December highs that I'm looking at. And then you mentioned the August high, which was something very interesting for us. I think that's, up around 4,300 S&P. That's critical. And we need to clear that, whether it happens in the next few weeks or the next few months. I'm not sure that that's as important of the time frame. If we consolidate for a little while, that's not going to upset me as long as we don't break lower through those December lows would be concerned. So, February, which is where we're at right now in the next couple of weeks, generally the weak link in the best 6 months from a seasonal perspective, but much better in pre-election years. We've got some stats out there on that. I mean, it's on the feed if you want to look for it. So I think you're on to the importance of clearing some more resistance levels and putting some distance between them and as where we are now. But next couple weeks, for me, it's not necessarily as critical as the levels themselves, whether it happens, sooner or later.
You had mentioned Russell 2000, and I keep on tweeting, watch small caps, because it's related to breadth. There's many more small cap names than large cap names. Small caps are an interesting part of the marketplace. If you look at the Russell 2000 divided by the S&P, the ratio is back to 1987 levels, which means that if you held the S&P or small caps going back to 1987, you had the same return, but with a lot more volatility being in small caps. Any interesting findings when it comes to seasonality for smaller cap companies, in particular in pre-election years? It seems to me that that's where it could be really interesting if you want to be bullish, especially given the sector composition being different than the market cap weighted averages.
Small caps, again, full disclosure, I own the IWMs. We're in the small cap season right now. People mention the phrase the January effect. I'm not sure everyone knows what it is, but it's the tendency for small cap stocks to outperform large caps in January, as documented in the Almanac on pages, I think, 112 and 114 this year. If memory's 114, I think yeah. most of that January effect really starts in mid-December, kind of starts bottoming, where small caps are underperforming in October, November. Then mid-December, they start to take off. And most of that's made in the last couple of weeks of December, then into mid-January. A little bit of a dip at the beginning of Feb, and then it continues to rally into March. So seasonally, whether it's whatever year you are in the 4-year cycle, and I think just the fact of the overarching bullish tendency of pre-election years is going to make that potentially even stronger for the small caps right here during this period of time. So that's what I think is more important, or at least most important right now for the Russell 2000 and the small cap sector.
And again, that would also coincide and confirm the strength in housing, because small caps are more sensitive to the domestic economy. Lumber showing strength. Now you got the small cap follow through. I mean, this whole idea of leading indicators, they move in advance of the other parts that then react with a lag, which I think personally is what's happening in the short term. Let's go to my friend.
Yeah, we're seeing a sector rotation tech got hammered last year, and we're seeing, I think all those big tech layoffs that were announced, I think that's the sort of end, and that's them cleaning house and realizing that they can't be staffed up for, 10, 20, 30, 40, 50% growth. It's more like 5 or 10. And I think tech's telling us by its performance in January, being the proponent of the January barometer, the son of the inventor, that what happens in January, so goes the year. And I think that's also, I know Sam Stovall does it with sectors, which he and I are going to be talking about that at some point together. So I think you're seeing the January barometer for NASDAQ and the tech stocks telling you that it's the sector to be in, and all the other factors that I've mentioned with the cycle and some of the other, with the bear market after, prior to a trifecta and NASDAQ. I don't know if I even mentioned that. I think that bodes very well for tech here in 23 after being sold off so much. So you're seeing it right, Mike. And I just want to make sure that, yesterday was the end of January. The January barometer did come in. I think I mentioned a little bit in the beginning, and that makes our January indicator trifecta 3 for 3. With the Santa Claus rally, which was the last 5 days of the year and the first 2 of the new year, not any random period that people like to talk about, and the first 5 days, early warning system, and the full month January barometer, all positive. And, we put this out yesterday in our subscriber note. The last 31 times that happened since 1949, 28 of the full years were up, only 3 down. That's 90%, of them. Average gain, 17.5%. That's 17.5. But taking away January and just in the last 11 months of the year, up 27 of 31. That's 83%, 12.3% gain. And then you take the years where you had the bear market in the year prior, and I did a chart, which I haven't put out on the blog or the Twitter feed yet. These 13 years since 1949, where you had a trifecta after a bear market, up 13 of 13. And the full year's not all double-digit gains. Last 11 months, up 13 of 13. Average, so the full year gains average is 22.1%. Last 11 months, 16.8, with a couple of higher single digit gains, 3 of them, the rest of them pretty solid. And then I did a chart of NASDAQ, Dow, and S&P in years where there's a trifecta after a bear market. NASDAQ's soaring up at the top, nearing 32% gain for the year. I don't know if you remember, I said the sweet spot for the 4-year cycle, NASDAQ's up 29%. But I'm still seeing the seasonal pattern on this chart where you've got, Q1, Q2 up really strong, sort of flattens out and bounces around, goes a little sideways through the worst 6 months with a low point in October, very typical. And then the last couple of months of the year, November, December, really strong. So tech's looking like it's showing its strength early on.
I'd also add, I think tech is a contrarian sector trade in the context of everybody screaming about energy, right? And this is the thing; it's like whether it's tech or small caps, the bear market started February 2021 for a lot of the tech names. The bear market for the vast majority, from a breadth perspective, started February 2021. So time would also argue that you're due, right, for these areas to start leading again.
Yeah, it's similar to the tech story. They were down and out for quite a while, and we're seeing China open, and a lot of things around the rest of the world, post COVID and bear market coming around. I mean, I saw a stat, I think Ritholtz put it out he picked it up somewhere where, there's not really any foreign markets or any market in the world that's in a bear market right now. So I'm not a huge foreign market investor, but there's definitely some beta over there and some alpha over there, excuse me. And I think, again, it's showing itself right here in January and coming off of, 12 months or more of being in the doldrums. So definitely a place to be in 23.
I'd add real quick. I keep going back to this point, and I'll keep hammering this because I don't think many people really understand sort of why I keep showing these distribution returns on the S&P and emerging markets. When QE3 and zero interest rate policy took place, it's fact. You did not have that sort of more classic fat left tail where you'd have a higher degree of frequency of large declines than what you would see in a normal distribution. You're off the zero bound. You don't have zero interest rate policy. You don't have QE anymore. We can debate whether it comes back or not from here to tomorrow. But the reality is the removal of all this accommodative money is that it now normalizes the playing field in terms of risk for stocks domestically and overseas. So if valuations for international didn't matter for the last decade because we had this unfair advantage of QE benefiting U.S. stocks, and now that's gone, valuations for international shouldn't matter. So I do think part of this what we're seeing, I myself think that we're in a new regime that really does favor anything and everything outside the U.S.
I'm not so sure QE's so over. I think they're going to be forced to back off pulling away the full punch bowl. If you look at the M2 numbers, it's come down, percentage-wise quite a bit, but it's still elevated. I don't think we're going to go back to pre-pandemic levels too much. We'll probably end up still being around 6 or 7 trillion. Maybe they'll pull a couple off there, but it doesn't look like it's going to contract that much. I'm not sure that they have that they really can pull it all away to pre-pandemic levels. I think you need to change your mindset that you're in a bear market, and I think you need to find the stocks that fit your portfolio, your strategy, individual stocks. I'm not sure this is the medium or place to be throwing out individual names. I've got some, at my website on my list at stocktradersalmanac.com. I think you could do very well just being in the main index ETFs, the Qs, the Russells, that sort of stuff. But and some of the sectors that we've been talking about here. But individual stocks, the ones I pick are a little too off the radar to be thrown out on a Twitter space.
Let me ask you something that I always see as sort of a counter to a bull narrative, which is that valuations are still elevated.
Mm-hmm.
As if valuations seemingly only matter when you're bearish. Nobody cares about when you're bullish, right? How do you think about sort of the interplay of fundamentals, valuations, and where we are in a particular presidential cycle year? I have to imagine that the cycle dominates more than fundamentals, but maybe I'm wrong.
I don't think fundamentals are the dominant force. I think they're definitely a big force. I'm not one of those guys that all it matters is earnings. One of my big fundamental metrics I look at is price to sales, which is much harder to manipulate on the financials. So I look for revenue growth and acceleration of revenue growth in the stocks that I pick, along with earnings growth and acceleration of earnings growth. But I think the 4-year cycle is showing its strength right now. And there are times when, these different disciplines are more impactful. The 4-year cycle to me looks pretty impactful right now with the midterm bear and bottom in October last year. Fundamentals, probably a little bit less so right now because we've been through all that negative fundamental downdraft and the market anticipates that. I think technicals are proving to be more impactful and constructive right now with some of the breadth thrusts and advanced decline line stuff and trend line and moving average, breaching we've been doing. So yeah, I'll give the pre-election year and the 4-year cycle a bit of an edge right now. First term, midterm, pre-election years are stronger because it's the first time they're really trying to get reelected themselves. And there's a chart of that in the Almanac, and we do that. We break it down into, the parties as well. We find that first terms, the pre-election years are stronger. And yeah, I mean, it does have an impact with the first or second term.
What about other sort of maybe kind of shorter term seasonality patterns that you've seen? I mean, we can debate whether you want to call it seasonal or not, but FOMC weeks, from the research I've done and the work I've done, they tend to be up. And FOMC weeks tend to have better returns than non-FOMC weeks, despite all the talk around, Powell's going to just whack the bulls on their head today. Maybe he does, but the odds are simply not in your favor. Any other interesting kind of short-term things that repeat that are worth?
Yeah, I mean the FOMC days are interesting. It's not quite as regular to really. I mean, it happens all the time, but it's the cycle is a little bit odd. It's about every 6 weeks or so, and it's not quite exactly the same. There's been several trading, I guess, strategies that have tried to game the Fed. I think it's not quite as repetitive. It depends more upon whether you're a tightening cycle or loosening cycle, or what kind of Fed you have there. If they're more vocal, I mean, the Fed's been getting more transparent over the years anyway. But we look at turn of the month stuff, which is working right now. I mean, today's the first day of February, one of the more bullish first trading days of the month. But with the Fed, people being afraid of what the Fed's going to say is going to be too hawkish, I think that's having more of an impact right now. We also had the big January. I said before, February tends to be the weak linked, especially after big January gains. But in pre-election years, it's stronger. You've got the President's Day holiday trading, which is a regular recurring event where people tend to do things and leave the market in the street. That's become more bullish than it used to be. The best 6 months we're in right now. I mean, I don't know if that's short enough term, but there's pretty much something. You got options expirations. We cover a lot of that in the book and on our newsletter, and a lot of stuff we put out on the Twitter feed and on our blog too. So there's always something on the calendar, whether it's up or down or sideways, that you can trade, or at least not make a move or make a move in your portfolio, depending upon what the seasonality or pattern is telling you.
I know you do some work with the commodity space,
Yeah.
Jeffrey. Any interesting observations when it comes to commodities? Because that does relate to sort of where we are in the inflation cycle as well.
Well, we're going to be putting out Commodity Traders Almanac for 2024. Last one we did was 2013, and we got the rights to that back. So if anyone's interested in the Commodity Traders Almanac for coming out later this year for next year, you can go to stocktradersalmanac.com and click on the tab for Commodity Traders Almanac and let us know that you want to get updates on it, and we'll make sure to inform you of it when it comes out. Right now, the commodity trades that we're looking at are energy. Copper's in play right now, gold, natural gas. Some of that's running away. Looks like oil and the energy stocks are coming back a little bit. It just looked like they were down before. But right here in this period of time, the energies and metal complexes are in play. Copper tends to bottom in December. Oil and gas, usually December through February, they find a low. I think we had a little exogenous impact from what's happening over in Ukraine. Those are the main commodities that we're looking at right now.
Maybe for the last few minutes here, again, everybody make sure you follow Jeffrey Hirsch and check out Stock Traders Almanac. This is more kind of a behavioral psychology question. How do people rewire themselves to think in terms of historical probabilities? Because the data is out there, but seemingly people just don't want to pay attention too much to it.
Well, I don't know. The Almanac's been around for 56 years. We're definitely doing a 57th edition. It's a nice little spiral-bound book you can keep on your desk. Mine's open right now while I'm talking with you guys. It comes free with a subscription to my website and reports, and I think you got to get into the book and look at it. I mean, I'm visual, so you got to go through and look at these patterns. We do a lot with seasonal charts, and you got to keep these things in the back of your mind. When certain times of the year, you got to have your antenna purring. Coming into the end of the summer, there's that summer rally hype everyone was talking about in August. We looked at that and said, it looks like we're about ready to end that summer rally and head towards the sell-off in September, October. I mean, people talk about it when it's in the news, but the trick is to study it even when it's not in the news and be ready for it when you see it so you can recognize the pattern. Sometimes it doesn't always set up right. I mean, we do a lot with seasonal patterns with sectors and the commodity complexes, whether the underlying sector or the commodity is actually tracking the seasonal pattern well or not. And if it's not, then maybe we're not going to institute that trade or get into that pattern if it's not really setting up well. Again, like we were saying with the pre-election years and the midterm years, same thing. It's set up really well for a big pre-election year with the bear market last year. If we didn't have, a sell-off in the midterm year or the pre-election year, the post-election year or the midterm year, maybe think the prospects for the pre-election year aren't aren't as bullish as they would normally be. So you got to just, take some time to incorporate cycle analysis and market history, and not just counting of, this is the best January since, '01 or whatever date it is. It's more about the history of the changes in how people move their money about. And most of the stuff is driven by the movements of institutions with their money and the quarterly adjustments. And, you've got the October situation with the October 30 about as much as anybody, where there's an accounting reconciliation that requires transactions to be made before the October 31st, which creates that October phobia, which has been going on even before that, because you've got this tendency for people to gear up for year end, and October sits at the confluence of the year, the end of the beginning of the fourth quarter, the setting up for the end of the year. And, it really makes a difference if you can get yourself geared to the pattern of the market. I mean, that's what the Almanac was made for, so that you could follow your own schedule along with the markets. That was Yale's motivation back in '66.
I think it's a good place to wrap this space up. Special thanks to others that keep on obviously appearing to join these conversations. And of course, to Mr. Jeffrey Hirsch, who's always a wealth of knowledge. Thank you, everybody, for joining. Thank you.